I'm Chad Moutray. I'm the chief economist at the NAM. I also straddle over into our nonprofit, which is the Center for, or I run the Center for Manufacturing Research at the Manufacturing Institute. Hopefully most people know me from my Monday economic report. If you are members of the NAM, I email you every Monday morning and hopefully cheer you up, or vice versa. But I also post it up on Twitter, which is my Twitter handle there at the bottom. And I'm going to just start off talking about what I'm seeing in the economy. Now, full disclosure, this survey that I'm going to talk about here is already done, and I think it's going to be released next week for the second quarter. So if you listen really carefully, I'll talk about the data for the second quarter, although that's not what these charts show. Let's start here. So this is the NAM Manufacturers Outlook Survey. We've been doing it for 25 years. You can see it's the average historically is about 3/4 of our members are positive at any given time. You see the huge decline, obviously, at the beginning part of the pandemic. That was the shortest recession on record from February to April of 2020, and the huge rebound that we've had since then. This is going to show you the second quarter up to the first quarter. You can see that in March, roughly 89% of our members were positive about their company's outlook. So note that the very last day that this was in the field in the first quarter was the first day of the Russian invasion of Ukraine. So I think when we released this, we somewhat soft pedaled it, knowing that it probably was a little lighter than that. And off the record, the number falls to roughly 83% in the second quarter. So don't repeat that. The one word, if you're reading my Monday economic report, the one word that I overuse is the word resilient, right? And so, you're starting to see a little bit of softening in overall manufacturing activity. The 83% is still some degree of softening, and you see a lot of other measures that are part of that, which are weaker than they were in March. But the reality is that manufacturing is largely held up, right? So I don't bury the lead here. Yes, things are getting a little softer, right? And we'll talk about the challenges in a second. But 83% of our members are positive about their company's outlook. That's still a great number, right? And I think what's amazing about that number is that in spite of all the things that have been thrown at manufacturers over the last 2 years, demand has largely held up. Now, when I travel around the country, and I was just in Minneapolis a couple of weeks ago, but I try to get out as much as I can. You often have this split screen view of manufacturing. Right? So you ask people about the economy, about the challenges, about inflation, about the prospect of a recession, you're going to get one answer. But yet, if I were to turn around and ask, how is your company doing? You often will get a sense that they can't keep up with demand. The pricing, they're able to get away with pricing, passing on prices pretty freely, right? I've also started to get a sense that there are some slowing of that in more recent conversations, including one that I had about an hour ago. But in general, you get a sense that at least on a company standpoint, there's a bit of resilience there, which kind of stands out. But let's talk about the challenges, because that's where Mike, you started the conversation, right? So the number one challenge in March was supply chain challenges. And the top four really have not changed all that much really since the beginning of 2021, right? The number one issue in June is inflation, but they're all pretty much right up there, right? And the reality is that supply chain has really become a buzzword, right? So if you ask people what their supply chain challenges are, you're going to get a mixture of answers ranging from COVID-related closures in China, right? And that continues to be a lingering challenge, even though it is quote unquote better. The ports, obviously, both leaving China and also here in the US are a big challenge. There's a prospect of a port strike, West Coast port strike at the end of this month, which we're following very closely. There's the lack of truck drivers, there's the lack of workers, there's soaring costs. There's a number of these factors which really kind of all are, at least in my mind, kind of lumped together and simply referred to as supply chain challenges. But they all are part of the same picture, right? So, on the attracting and retaining a quality workforce side, we have 45% of our members who tell us that they had to turn away work because they don't have enough talent, right? It's not just a matter of not being able to find workers and the soaring wages that we'll talk about a little bit later, but it also is having a real economic impact for them in terms of being able to do what they do, right? And then obviously soaring raw material costs, and add to that energy, add to that just a number of other commodities there. And so, those are still the top challenges, even when you move into June. And there's some prospects that maybe some of those might be better, but they're not back to where they were pre-pandemic. They're just maybe better than they were a month or two ago, right? So I think that you're still getting a sense that these challenges are very real. My personal view is that the Chinese problem is not going away so long as they continue to have the zero COVID policy, for instance. And so that while Shanghai is opening up, there's other cities that are being closed. So this is kind of a lingering issue that's going to be out there for a while. So this chart, and I'm only giving you one chart, but let's give you a little animation here, right? At least visually in your head. So the first time I asked this question was the fourth quarter of last year, right? Mostly because I kept getting asked and I really simply punted it to our members. And last year in December, most of our members had this cautious optimism that supply chain issues were going to get better at some point in 2022, but largely it was mostly at the end of 2022. So the second half of 22. So 54% of our members said they thought supply chain issues were going to get better at some point in 2022. Flash forward to the March survey, which is the one that's on the screen here. And you can see that yeah, you still had this cautious optimism that things might get better in the second half, but you saw some bleeding of that over also into 2023, proving that this issue is becoming much more sticky than I think folks even thought just 3 months prior to that. Now, flash forward to the survey that's going to be released next week, and pretty much all of this bleeds into 2023, right? Again, given all those, the port issues in Russia and China and just a number of other factors, there's this belief that these issues are dragging on a lot further than I think people thought, right? So you have more than half of our members who expect that at some point in 2023, things will get better, right? Now, let's put a little asterisk after the word abate or better. That does not mean these problems are solved, right? It just means they're getting better. There are a lot of structural issues that are going to take a lot longer than this time frame suggests, right? That we're not going to solve the workforce crisis overnight, right? The ports issue is getting better, but not, vastly better to pre-pandemic levels. And the chip issue is not going away, right? Yes, we're building new factories and foundries in the US, but that's probably more of a 2023, 2024 conversation than it is a 2022 for sure. But if you're looking for some glimmers of optimism, that's where you're going to find it. Moving away from the NAM survey, you get a real sense that sentiment has really taken a dive here more recently, largely related to what's happening in the Ukraine and what's happening in China. And so you see, if you go back, at this point last year, very robust new orders, very robust production, at least according to the ISM survey. Keep in mind, numbers over 50 are expansion, so we were actually over 60 for much of that time period. And then up until the spring of this year, you still had pretty solid gains for both new orders and production, and then Russia invaded Ukraine, and then obviously the China situation. Again, don't bury the lead here. Things are softening, but the PMI number, this Purchasing Managers Index number, is still 55, right? So it's still suggesting modest growth. It's just slower than it was 3 months ago, 6 months ago, et cetera. So you're still seeing this sense of resilience in the manufacturing sector, even though when you look at this chart, you clearly get, it looks perhaps worse than it really is, right? You're still seeing positive growth, just not as much as we would like. Now, the yellow line is curious here because the overall employment has been a bright spot, and yet employment on this chart has really hovered around 50 for much of the last year, and in fact, it contracted again in May. That has more to do with the difficulty in hiring. If you're reading the actual narrative from the press release from the Institute for Supply Management, it has more to do with, yes, they want to hire, they just can't find people to hire, right? Or there's lots of churn or that kind of stuff. And we'll talk a little bit about that later. This is probably the only survey where you're having that kind of interpretation of the employment measure, but it is notable here that is really what that's picking up. So at the end of next week, we're going to get manufacturing production numbers for May. So we're going to be looking for, are we still resilient in May, right? Things are clearly cooling when you look around the economy, But if you look at the prior 3 months, February, March, and April, we've had a really strong, very solid levels of manufacturing production in February, March, and April, really coming off of a really weak December and January, largely related to supply chain issues, largely related to what's happening with the Omicron variant, right? But we've rebounded from that very strongly in a very broad-based way over the last 3 months. My prediction for what we're going to get for May is you're going to see manufacturing production grow around 0.4, 0.5% when we get the May reading. Still positive, still a decent reading overall. And it's a sign again that even with all of the challenges that are out there, at least in my view, we're going to have still this lingering resiliency that's at least for the May figures. Now, what does that mean for manufacturing production? So this shows you obviously the very steep decline in manufacturing production and capacity utilization. But we've also rebounded to such an extent that manufacturing production is up 4.6% over pre-pandemic levels, right? And we're at the best level of each of those really since right around the Great Recession times, right before the Great Recession. So in both of these cases, you're seeing very strong levels of activity. Now, will that soften? It potentially could soften, but again, these are nice positive signs that at least for now, in terms of the data that we're getting, manufacturing is holding up, which is encouraging. I won't bore you with the month-over-month numbers. I'll send you these slides so you won't have to feel like you have to take copious notes. This is just showing you the month-over-month for April. Again, we're going to get May next week, so we'll be looking for continued signs of improvement there, especially for motor vehicles, which has just gotten hammered over the last year on the chip crisis. A couple months there of really solid gains. For me, the more interesting numbers are looking at that post-pandemic world. And I suspect I'll stop looking at the post-pandemic world at some point, maybe when all these numbers are positive. But you're seeing a lot of strength here. Obviously, aerospace is doing well, given where Boeing is doing. I hesitate to use it in the name of one of our members, but Boeing obviously is in a better place today than it was 2 years ago. And obviously, you can read through the rest of this list. Obviously, computers makes sense why that would be number 2. Miscellaneous durable goods, you can insert the word medical equipment, right, and PPE, and that would make a ton of sense to you. And chemicals, if I were to insert the word pharmaceuticals, that would make sense to you as well, right? So when you're looking through this list, it certainly is helpful, I guess, to look at it in that context. For me, the other thing that's encouraging here is that some of these sectors towards the top of the list have had some pretty significant supply chain challenges, and yet most of them are showing some, year over year, growth really over the last couple of years, which is positive. So a couple charts in here I'm going to show you, which are giving you if you're looking for lots of happy faces in your overall outlook, this is one of them. So there's 2 here. The other one I'm going to show you is job openings. So this is physical capital. The next one will be human capital. And so this comes from factory orders. It comes from our durable goods data. It's non-defense capital goods excluding aircraft. It's a proxy for capital spending in the U.S., right? So this is business spending, capital spending. And notice it's not just continues to get above pre-pandemic levels, but it just keeps hitting record highs each successive month. Now, to be fair, these are nominal numbers, but nonetheless, they still are hitting record highs. And it's a sign that companies are reinvesting in themselves, right? And this is also consistent with when you look at the GDP data, you're seeing really robust spending increases for equipment and for intellectual property products, both of which are signs, at least to me, the companies are making smart investments in themselves that are going to help them grow productivity down the line. Obviously, intellectual property products, the software and R&D, right? Those are things that are going to be able to be very productivity enhancing down the line, which is encouraging.
And Chad, these numbers do not include non-working cash or working capital for production and process. This is infrastructure investments. Is that fair?
These are orders and shipments, right? So these are goods that are being ordered or shipped. And again, they're a proxy for capital spending. They're not perfect for capital spending though. So some of what you're talking about would be more in the BEA data as it relates to GDP. But yes, these are goods for the most part.
Okay, thanks.
Okay, so there's that. Now let's turn to the global economy. So if you get my Monday economic report, you also get my global report, which comes out tomorrow, actually, because it's the second Thursday of the month. And look at the sea of blue up here, right? 9 of the top 10 markets that we sell into have expanding manufacturing sectors in the month of May, right? The only holdout here is China, and that has everything to do with the zero COVID policy. The fact that you've had closures, you've had continued difficulty with overall production. People are still restricted in going out, right? This is having a lot of impacts, and you're seeing lots of weakness throughout China. Now, the reality is, as goes China, so goes most of the rest of Asia. So you're seeing a little bit weaker growth than you would have otherwise really throughout Asia, although it's notable here that none of the other countries in Asia are contracting, just China in this case. Probably North Korea is too, but they don't have a PMI, it's a joke. Overall, you're seeing a little bit weaker data in China. Hopefully that will improve as you move into June, but again, the zero COVID policy is not going away, so there's still some risk there. The other comment up here to make is you've continued seeing some softening throughout Europe in general. You have some markets here that did increase, like the UK got a little bit better in May versus April. But in general, you've seen these numbers decelerate over the last few months, largely because of the Ukrainian situation, right? And the overall Europe is growing around 1% this year. Lots of risk for them, much greater risk of a recession in Europe than in the US, because of their proximity to the Ukraine, because of their over-dependence on energy, and the soaring inflation you're seeing there as a result of that. Still growing though, notably, right? But not growing as fast as we might like. One other comment to make up, well, I guess two other comments. Emerging markets, you see them contracting. Well, number one, the comment to make here is that China is an emerging market. Now, we can disagree with that designation, but that's what's pulling them down. But the emerging markets in general are getting hit by the fact that the dollar is strong, right? And many of them have felt that they've had to raise interest rates to stay competitive. You also have some lingering food security issues there. You know, you keep in mind the Ukraine was the breadbasket to the world, and so there's a lot of worry about where food is coming from in some of these emerging markets. And so they are a little bit of a weak spot as well. The U.S. figure, notice it's actually a little bit better than the ISM number here. The U.S. is a bit of an island, and I'll use that phrase a few times here in this conversation. While we have a lot of challenges in the U.S., the U.S. is doing better than some of our trading partners, right? And so that plays itself out in the strong dollar. It plays itself out in what the Fed might do versus other central banks, and it certainly plays itself out as it relates to net exports. So hold on to that thought. We'll talk about net exports when we talk about GDP. So on the employment side, with very strong growth, employment continues to be a bright spot. We created more jobs last year than any year in history. 6.7 million jobs were added to the U.S. economy last year. Now, keep in mind that was a bit of a dead cat bounce, right? We had a really crappy 2020 followed by a really strong 2021. Yet we are continuing to see some pretty solid gains even into this year. You know, hovering around 400,000 jobs in each of the last 3 months, still pretty solid readings overall. And the unemployment rate, as you know, has fallen. Actually, Nebraska has one of the lowest in the country, so you know it better than I do. Nationally, of course, we are 3.6%. I keep expecting us to get back to 3.5. That didn't happen this last month. 3.5 would be where we were before the pandemic began, and it was the lowest since 1969, right? So we're hovering around the lowest in 50 years, but also hovering at kind of that full employment territory. With that said, the overall labor market looks completely different than it did before the pandemic. A lot of folks have left the labor market, moving to the sidelines, or they've retired. Immigration plays into this, right? Because we don't have immigrants coming in and filling in some of these roles. And so overall, the labor force participation rate is a little bit more than a percentage point below where it was before the pandemic began. And even though we've seen this number inch a little higher in recent months, certainly since last summer, I don't expect us to get back to pre-pandemic levels of labor force participation rate. The trend line was already negative anyway because of demographics. And I suspect we will continue on that longer term trend. And that's going to exacerbate the skills gap challenge that all of us are facing right now. In the manufacturing side, don't make too much of that only 18,000 in May, because the reality is we've added more than 200,000 workers already just through the first 5 months of this year. So very solid growth in manufacturing employment. Last year, we added 365,000 workers, which was the most since 94. So we're continuing the solid trend of manufacturing employment growth. And we're only 17,000 workers shy of our pre-pandemic levels, right? So we're going to be back at pre-pandemic levels of manufacturing employment in the next couple months. So maybe even as soon as the next month. So very, very steady overall manufacturing employment growth. And we're just shy of 1 million job openings in manufacturing nationally. So 996,000, an all-time high. I've been at the NAM 11 years. I remember when half of that number was a great number. I remember 500,000 was a great number, right? And when it was an all-time high. Now we're close to 1 million. So these are very elevated levels of job openings in the US. Again, don't bury the lead. The green line also has been improving, right? That overall hiring pace is the best we've seen in a number of years as well. So again, overall employment continues to be a bright spot. Now, this number is very elevated as far as job openings, and part of what's keeping that number elevated is that we are in the Great Resignation, right? So this is the Great Resignation chart. This is quits. So quits were an all-time high in March. As you know, they slipped a little bit in April. These data have a little bit of a time lag relative to the other job numbers, but we still had 4.4 million Americans quit their job in April alone, nationally, not just in manufacturing, but in all sectors, right? So there's lots of churn out there in the labor market, right? People are quitting their job, they're going across the street and getting you're doing some job switching, right? Maybe going for
Oh no, did we lose Chad?
Looks like it.
Okay, I just wanted to confirm it wasn't me. We'll give him a minute or two and then I may send him an email here simultaneously. This is interesting stuff.
If he doesn't get back on, you're gonna have to pick up the conversation, Mike.
Yeah. My first question will go to you, Scott.
Thanks. I'll defer to JC.
Uh-oh, okay, we might have officially lost him. Let's see. Hopefully he'll come back in here.
That last chart was kind of interesting. It showed the number of quits in manufacturing was a lot lower than the general population, which is I would not have expected that.
So I'm back. I don't know what happened there.
All right. Hey, yeah, we've regained him. We lost you, Chad. In your talking about the amount of job switching that's going on.
Yeah. Okay. So that's what I thought. I'm like, I don't know what happened there. I'm talking and suddenly I lost the pictures of you.
Thanks for finding the ship again.
So anyway, here we are. Oh, I have to go all the way back. That's crazy. There we are. Okay. So that leads to this chart, right? Which you've seen as well, kind of in the press. For every 100 job openings in the US, there's only 52 people willing to take them, right? So that's just comparing the job openings, number of job openings, 11.4 million versus the number of unemployed folks. We're almost to the point where it's for every 2 job openings, there's only 1 unemployed person, right? So again, it speaks to why everyone and their brother is struggling to find talent right now. These are historic levels, right? We've never kind of had that level of spread. And the end result of that is this chart, right? Where overall wages in the manufacturing sector are near 40-year highs. So in March, we were 5.7% year-over-year growth for manufacturing hourly earnings for production workers. This is just to kind of put a number on this. This is just shy of $25 an hour, right? So we're currently, I think, $24.90 something per hour. And that slipped back to 5.5% in May, but still a very strong number overall, still near 40-year highs. So this shows you just the extent to which manufacturers have had to really aggressively compete for talent out there. 2 comments about this. The first is that other sectors, as you know, just by driving around town, other sectors are also scrambling for talent, and the year-over-year rates for some of those sectors are double digits, right? And so, you know this because, obviously retailers, hospitality, a number of those categories in the transportation and warehousing space have had to raise wages even higher than this to stay competitive. We still pay, for the most part, especially versus the service sectors, more than them, but you've seen that gap shrink over the last few months. The other comment to make here is that yes, 5.5% is great. It's near 40-year high, but so is the inflation rate, right? And everyone knows that the overall consumer price index is up more than 8%, right, year over year. Also the most since 1982. And so in real terms, even though these are great numbers, purchasing power has fallen, right? And I think most workers know that, and that plays itself out in the larger conversation about, who's to blame for that? Is it Biden? Is it Powell? Is it, those greedy corporations? So it plays itself out in a political context as well as kind of an economic context, which segues us off nicely to this chart. Now we will, by the way, we're going to be getting new consumer price index data on Friday, so we'll be watched very closely. So this is the personal consumption expenditures deflator. It's basically, that's a fancy way of saying that the price index for personal spending. And the reason why this is always my first chart, anytime we talk about inflation, is this is the preferred measure for the Federal Reserve. So if Jay Powell goes out and gives a speech, he's going to say he wants core inflation to be 2% over the long term. That's the red line, right? So it's overall inflation minus food and energy. Notice that in each of these cases, you've seen the year-over-year rate peak and start to come down again, right? So we've expected that for a while, right? Chris, who goes to our board meeting, you probably heard me say this in February and March. The reality is that as we continue to move through this year, right now we're comparing April 2022 with April 2021. As we move through this year and we have different comparison months, you're going to start seeing that number pull back a little bit. That does not mean that inflation is transitory. It doesn't mean that inflation is not a problem. It just means mathematically our comparison month has shifted. And of course, some folks are going to pat themselves on the back and say that inflation has peaked, but the reality is that you're simply just seeing a different comparison month. Now, we could see the blue line continue to go up. As you know, as today even, the price of West Texas Intermediate is over $120 a barrel. You've seen natural gas prices go up. So we could still see the blue line continue to move up. Food costs continue to be pretty solid, but we would expect that red line to start kind of moving down a little bit. My forecast for the PCE deflator is to be roughly 4%-ish year over year by December. So still double the Fed's goal, but a little improvement from where it is. The Fed, for its part, is going to raise rates next week. You already know this. They've already raised rates by 75 basis points, 25 at their March meeting, 50 at their May meeting, and they're going to raise rates 50 basis points both at the meeting next week, but also at their meeting in July. It's an open question whether they will either hit the pause button after that and kind of look around and survey the damage, right? Or whether they'll do 25 or 50 basis points again in September. I think the betting odds probably would be for at least 25 basis points in September, but if we're still having raging inflation in September, it would almost certainly be another 50 by then. So again, very aggressive moves to push up rates by Fed and the Fed funds rate. But the Fed is also starting to reduce the size of its balance sheet as of June 1st, which has ballooned to over just roughly $9 trillion. They're going to start slowly whittling that away, and that will also have some upward pressure on rates. Just to show you the consumer and price index charts, this again will change as of Friday when we get new consumer price index. The consumer price index is the highest since 1982, and the producer price index, which is basically wholesale prices, is an all-time high, but that number, as you can see, only goes back to 2009. So let's talk about a recession, because that's what you really wanted to ask me. I saved it for all the way till now. So I'm starting by using this chart kind of as the segue. About a month or two ago, this chart inverted, right, for the first time. So this is the 10-year minus 2-year Treasury bond spread. Historically, every time this is inverted, meaning the 2-year is higher than the 10-year, we've had a recession within 12 to 18 months. Going back to World War II. Now, to be fair, that's only really true with monthly data. It really only inverted for one day. And Other bond spreads did not invert. In fact, they came nowhere near inverting. So this is perhaps a bit of an aberration there, and people can really discount whether this means anything or not. The last time it inverted was August of 2019, and we did have a recession after that, but that had more to do with the pandemic than it did with the overall economy. With that said, you can certainly write this number off, but everyone asks me, when are we having a recession, right? And so this feeds into this larger narrative that's out there that the Fed really can't navigate a soft landing, right? And that's really what drove the inversion when this inverted a month or so ago. And it's what continues this lingering pattern, right? We ask a question in the survey that's coming out next week. How many of you think we are going to have a recession in the next 12 months, right? And off the record, it's more than a half, right? So there is this kind of drip beat conversation out there about whether we're going to have a downturn or not. And it plays everything to do with, can the Fed, in order to cool inflation, slow down the economy without sending it into a recession? And the betting odds, at least in some markets, is that that can't happen. My personal view is I don't have a recession this year. I don't have a recession in my forecast next year either. But the risk of a recession has gone up tremendously. I do not, and I'll underline this, do not expect a recession in 2022. I think when you look at the underlying data for 2022, overall consumer and business spending continues to be resilient. Go back to my earlier phrase, right? If you don't believe me, try traveling this summer and see what the price of travel is. Even with $5 gas, people are still traveling, right? Now, part of that is maybe they made plans before, right? So if we're going to see some cooling on the spending side, it might be later this year. But the overall consumer and business spending continue to mostly hang in there. And I think that's going to be key. The risk of a recession is greater next year, though, and I would peg the risk of a recession in 2023 at 40%. This is all played into consumer confidence, obviously the lowest really in more than 10 years. But let's go to the overall outlook. So you can see here, I have us growing around 2.6% this year. I have us growing around 2% next year. I do think that there's more, especially for the 2023 forecast, much more downside risk there than upside risk, right? So I could clearly see that number continue to come down. I know that the American Bankers Association economists have the forecast next year for 1.5%. They're probably on the lower side, but it shows you the extent to which a lot of economists are downgrading their forecast for next year. But before I talk about the forecast, let's talk about this fun negative 1.5 number that we had in the first quarter, right? So that was the first negative reading for GDP we've had really since the pandemic began. Lots of talk about that, lots of talk about how that, that's probably a sign of stagflation, et cetera. But when you dig into that overall number, you find out that it really wasn't as bad as advertised. That if you were to add, just a reminder, if you're looking at GDP, it's C plus I plus G plus X minus M. Remember that fun formula, right? If you just sort of do the C and the I, consumer spending and business spending, we would have had growth of a little around 3% in the first quarter. What subtracted all that away was net exports, right? The fact that we had a record trade deficit in March, right? Because we are importing a ton and exporting less, right? And so, as go back to my comment about us being an island, right? Net exports have really played themselves out in that way. So it subtracted out all of the gain we would have had, right? But you also had drags coming from inventories and from government spending, right? So again, the number was not as bad as perhaps advertised. I would expect a little bit of a rebound in the next couple of months. And then to the extent we're going to see some continued softening, I see it more at the end of next year. So we'll kind of end on this chart and then we'll take your questions. On the upside risk, consumer and business spending continues to be resilient. As long as the labor market continues to be tight and we have strong wages, that's going to be a positive for consumer spending. The US is an island and that has helped us relative to many of our peers. On the downside, and these are not orderly ranked. I mean, the reality is the biggest risk is the Fed, right? But obviously we don't know how the Russian invasion is going to play itself out over the coming months, and that certainly is going to continue to create some inflation, especially for food and energy, and obviously COVID. I think we're going to continue to have the net zero COVID issue coming out of China. Slower economic growth in general. You saw the World Bank lower their forecast yesterday, not just for Asia, but also for Europe, especially. And then we're continued kind of pricing pressures to kind of continue to antagonize us. I think that the challenge that we have, the other kind of big downside risk that I have is go back to my survey question. The fact that everyone is building in, and I had the same conversation when I was in Minneapolis last month, a couple of weeks ago, people are building into their forecasts that we're going to have a downturn, right? And so I think the red flag that I would put there is if you're building in slower growth for next year, you're probably also building in slower employment growth, slower capital spending growth. And so you somewhat become a little bit more self-fulfilling. So I think that's another big downside risk that's out there in the economy. A recession is not inevitable, but you're certainly having continued talk about it. I think is certainly having a negative impact on the overall outlook. So hopefully that was not too depressing. I know when I presented this in Minneapolis, people said, "Oh, you were more positive than I expected you to be." Certainly there's a lot of talk about stagflation, a lot of talk about a recession and inflation in the economy now, and I think that unfortunately that's dominating the headlines. So anyway, what questions do you have for me?
Yeah, this is Chris. Hey,
Chris.
I didn't hear you talk any about like inventory levels, like generally just, because of supply chain issues. Do you believe that because of supply chain issues, people are ordering more stuff to stuff into their supply chains?
Yes, I think companies are going to, I mean, I don't think just in time is totally gone away, but I think we're back to a place where it's just in time plus a huge hedge, right? And so I think companies are going to keep more inventory than they did would have pre-pandemic, just because they realize that if they don't have some of those, especially those inputs, they're going to have to shut down production, and that's the last thing they need. If you look at the automakers, right, they've not had to shut down production at all, really, over the last couple of months, largely because they're doing a better job of managing their supply chain, which largely probably means they're keeping a lot more inventory on hand and trying to lock down the suppliers as much as they can.
Then my follow-up on that then is if we believe that there's more inventory in the supply chains, when their warehouses are still coming in, but if they do start to see a slowdown and interest rates are going up, my concern is that you're going to see people say they're going to turn back really quickly because labor is so much more expensive. They're carrying more inventory. Interest rates are higher on that inventory. That's where I start thinking about 23 and what that may mean to us.
Yeah, that's definitely true. That's definitely true. I agree with what you said. So I won't say any more there.
Okay.
It looks like Sheila has a question.
Yeah, I do. What is causing the decrease in the net exports?
So go back to my comment about us being an island, right? We're seeing stronger growth in the US than abroad, right? Traditionally, whenever we Americans feel richer, we go out and spend it, right? So even though we might be more pessimistic on our consumer sentiment surveys, we're still going to go out and buy the new iPhone when it comes out, right? So we're still buying a lot. You're also seeing playing into those numbers, and you see this. I tweeted out the trade deficit numbers yesterday. You've seen a lot of the supply chain issues and higher petroleum. You've seen a lot of skewing in the data, right? As we've, from month to month, if you're looking at very wide swings on chips and a lot of other commodities, largely because of some of these supply chain issues and chip issues. So you're seeing lots of volatility there. But the other pocket of it is go back to a speech that Biden made a few weeks ago. The US is currently growing at a faster rate than China. Now that certainly gets under China's skin, and not shockingly, right after that, China instituted a huge stimulus to try to grow their economy again. But if you're seeing weaker growth in Asia, if you're seeing weaker growth in Europe, they're certainly not buying as much of our products. And so that's really what's playing into it, is that we are a bit of an island, but also you're seeing some supply chain volatility there that's kind of playing with these numbers from month to month. As a result of that, we had a record trade deficit in March by a lot, right? Look at the April data yesterday, a huge decline in the trade deficit. Again, that speaks to the volatility that you're seeing overall in the marketplace.
Yeah, so as a follow-up question to that, what do you think is the reasoning behind China's commitment to a zero COVID policy?
Well, there's a number of factors that are playing into that. Number one, and I didn't say this earlier, but China has become increasingly anti-US, and that has nothing to do with it, with the zero COVID policy. But I think that's longer term. That's going to be something that we're going to watch much more closely than the zero COVID policy. But between now and this fall, when they have their third Congress, President Xi wants to get a third term, wants to get another term. Is going to look like he does not want a huge rapid case of COVID around the time of his reelection. So they're going to do everything they can to kind of keep inflation, keep COVID at bay, right? All of us would argue that that's quite, the steps that they're taking are quite draconian, right? A handful of cases, you close down a whole, multi-million population city. But for the most part, they don't care. And I think that they have dug into that, for the most part. So for what I've heard in talking to my China watchers, is that they're going to continue the zero COVID policy at least until that Congress convenes and he's reelected.
Do you think that'll change his reelection prospects, or not necessarily?
Well, election simply means that the communists are going to vote for him. And so I think the only way that it would change is if the downturn is so significant that there's a competitor to his power, right? No one sees that emerging yet.
Okay, thank you.
So Chad, something that you didn't really touch on much, and I've seen this with a lot of other people too, is there isn't a real significant focus on fuel prices right now.
There is, and I think that that's part of what's slowing things down. Certainly the fact that we have $120 a barrel oil right now, you're starting to see some inkling on the consumer side of particularly at the lower income spectrum, people having to make tough choices, right? And so while consumers continue to spend pretty freely at the middle and upper income spectrums, you're seeing a much more penny pinching at the lower ends. So that's again a bit of a worrying sign. So you're going to see slower growth as a result of that, right? So I think every economist just had to downgrade their forecast really since February as a result of higher energy costs. You're also starting to see natural gas prices go up a bit as well. Although to be fair, none of these costs are as high as they are in Europe, right? Europe, we're around $9 for natural gas. It's about 35 to 40 or whatever in Europe. So they're seeing much greater impacts. It's a large part of why Europe is closer to a recession than we are. The worry that we have, if you're going to game this out, is the longer you continue to have $120 barrel oil, right? You're going to continue to see consumer confidence be pretty weak. You're going to continue to see people making tough choices as it relates to spending. And so that's going to continue to be a drag. The other worry that we have is I said this earlier, we don't know what's happening in the Ukrainian war, right? It could get worse, right? And so you could certainly game that out where you could have $130, $140, $150 barrel oil. And that certainly is enough that you could continue to shave off even more growth from GDP if that were to happen. And probably also would send Europe into a recession. So it is having an impact. I just didn't explicitly say it earlier.
And I appreciate that. And I guess, so then my follow-up on that is, I feel strongly that we're going to continue to see high prices, and not so much for the oil price. We've had higher oil prices before with the gas price not as low. The bigger problem we have right now is we don't have the refinery capacity.
Yes.
We're below 5-year averages on our distillates, and that's not going to improve. So as prices continue to increase on especially diesel, which impacts everybody in this call in every manner, I don't see how we can't be looking at a recession sooner than later, because to your point, not only are we going to have consumer spending, but prices are going to go through the stratosphere. We're going to have disruptions in the supply chain. I mean, I already have employees that are questioning if they can drive into work anymore. So the great resignation is going to accelerate, which is also going to disrupt the supply chain even more and cause.
And the fact that diesel is so high means you're going to start building in higher prices, and it's going to keep this cycle of inflation a lot stronger than the Fed would like, right? Because companies are going to be building that into their plans, right? It's going to have, the cost of everything is going to go up, right? And so this is why you're not going to get back to the Fed's goal of 2% inflation anytime soon, right? Because you're going to continue to see pretty significant wage pressures and pretty significant pressures because of what you described with diesel and other commodities.
Thank you.
Do you think that'll impact that great resignation sheet and then kind of the increase in demand from workers on more remote
So the way that plays itself out
flexibility.
is that if we were to have some cooling in the economy, that probably would cool hiring, right? Probably also cool some job openings, right? But at the same time, it also might lead to some more unemployment, right? So that probably would narrow that gap. I think structurally, you're going to continue to go back there, even if we had a recession. This is a long-term problem we're going to have to solve. The other kind of category, go back to the gasoline comment a second, is that with more inflation, maybe you had a one-income household, right? And now you're seeing such tremendous pricing increases that you're like, I can't make ends meet now. One of us is going to have to go back to work, right? And so you could see perhaps some folks come off the sidelines who were not working because inflation is such a challenge. So yes, it will play into that.
Do you have any, since we're here in ag country, do you have any specifics on ag? Because, you know, going back to the diesel prices and also the shortage on fertilizer and other things, I think that could have a significant impact on several things as well.
Yeah, and obviously the dollar is going to continue to stay strong as well because of where interest rates are. So that obviously hurts the ability to do exports. I don't follow ag as closely as I should. I shouldn't admit that, but I don't. But yes, I think in general you're seeing soaring commodity. You're seeing those costs continue to rise pretty significantly. But farmers are also getting pinched by the conversation we had earlier as well. Higher energy costs, higher inflation in general. So and they're going to get pinched on the fact that the dollar is so strong and it's going to hurt exports. Now, the one thing that will help is that there's a huge food shortage, right? Ukraine was the breadbasket of the world. And there's a lot of worry out there about starvation in some of these emerging markets because no one really can replace all of the grain that the Ukraine made. So the U.S. can help. Brazil can make more, far more as well, but that does not make up the gap, right? So there's a lot of worry from what I've heard in the emerging markets about soaring food inflation and possible starvation. But that could lead to increased production for farmers, obviously, at least increased demand. We can't end the conversation, Mike, with starvation in emerging markets. We've got to have a more positive ending than that. So I guess my only positive comment was hopefully I'm glass half full here, right? and even while we do have some wiggle room to play with, which I think is a luxury that the Europeans don't have, right? So that to the extent that we can navigate a softish landing, to quote Jay Powell, that's really what helps, right? Is that you still are seeing the consumer and businesses hang in there to a certain extent, although there certainly are red flags for both of us.
Yeah, that's if anything's tangible right now, your point on demand really being the side of the equation that's very strong right now. We can go sort of on and on about the next sort of permutations as interest rates rise and as inflation takes over, what that does to demand. But at least in the short-term outlook, it seems like demand is so healthy. And I think you certainly read what we're experiencing in Nebraska extremely well, which is our unemployment is incredibly historically low. And workforce, as much as we are trying to solve that difficult equation, it's going to take a while to solve that equation. I'm curious on that workforce point. You talked about participation rate and its decline, and you mentioned immigration as a possible lever around that. Do you have any insights on what the outlook is there?
Well, the challenge is that we have declining birth rates in the U.S., right? We have this huge labor force gap that we talked about earlier. And traditionally in the US, we would have closed some of that gap with immigration, right? And yet really since 2016, we've been much less friendly to immigration than we were, right? And so that really it's a challenge, right? And so, we would certainly be pushing for some form of immigration relief right here, increased visas. We've long been pushing at the NEM for comprehensive immigration reform. So I think that's part of the puzzle here. Now, is there the political will for that? That's a big question mark, but certainly it's part of the solution. should we choose to go there.
So Chad, you had a chart on GDP. Does the NAM track anything with gross output? Since in my opinion, that's a more accurate measure for manufacturers than GDP is.
Even Jason Furman loves gross output, so you're not alone there in looking at that. I mean, obviously, I don't track it as closely as I do GDP. I mean, certainly I have access to it. The BEA puts that out, but so no, I don't. I guess I don't follow as closely as I should. But yes, I've heard again, Jason Furman, formerly in the Obama White House, swears by gross output as a better measure than GDP. So you are not alone there, Scott.
Well, thank you. Yeah, it interests me that there isn't a lot of people that are tracking that very closely. I do think that for us, especially manufacturing, it would be a lot better measure for us to be using.
Yeah. We do look at value-added output. So you'll see me talk quite a bit about value-added output and stuff. So I do follow that a little bit. I just don't follow it as far as as a competitor to GDP so much as I look at it more for talking points of, the US, manufacturers produce 2 point something, trillion in output. I think that kind of notion.
Thank you.
Those numbers are all-time highs as well, by the way. But again,
Yeah.
even on the in real basis.
JC, if you're asking a question, we can't hear you. Maybe we'll get one in the chat. Oh, bummer. Bummer. Well, maybe is there anyone else who may have a question to buy JC a little bit of time here before we let Chad go?
I'll jump in and ask one.
Please, Dave. Yeah.
Chad, you had on one of your earlier charts, you had the growth and capacity for the aerospace industry.
Mm-hmm.
What's the basis for that? And I live in that space, and
So go back to February of 2020.
that right?
Just remember what the aerospace sector looked like at that point. And again, I'm not picking on any company here, but there was, Boeing was really plagued by the MAX issue. There was a lot of challenges there with that. Then we hit the pandemic, people stopped flying, right? So we've turned a corner from that notion is really what's happening. Part of it, of my comparison there is I'm looking at February 2020 to now, right? So I'm picking a point where the aerospace sector was a bit down and comparing it to now where everyone is flying and everything's back to pre-pandemic level. So that's a large part of why they're doing better. It's just more the comparison month that I'm picking.
Does it take in more than the manufacturing sector of aerospace? Does it take in airline, air travel, all that? Just there?
So that one is aerospace and miscellaneous transportation equipment. So that would include aerospace, but it would also include boats and ships and other forms of miscellaneous. It might even include forklifts, maybe. So it's encompassing more than just aerospace in that number, but clearly dominated by aerospace.
Just across our industry, there's a lot of open capacity because Boeing is not nearly back at the rates,
Yes.
even close to where they want to be on 737.
So that was not a capacity chart, that was a production chart. So it's looking at production changes between February and now. So that 17% is just showing that they've rebounded from a relatively weak point.
So it's more of an output chart.
Yes, it's an output chart.
Okay, thank you.
So JC has typed, at the manufacturing summit in the fall, the presenter was not forecasting a recession due to large demand savings. Do you agree? And is that still true? So the savings rate was very elevated for much of the pandemic, right? Lots of free money was given, passed out from the government, right? And that kept savings rates pretty elevated, right? People were also pretty scared. We've seen the savings rate fall below pre-pandemic levels more recently, though. People have had to dip into their savings to fuel consumer spending. You've seen credit card indebtedness, people being more willing to take on credit card debt than they were before the pandemic. Not in any scary way, right? But you've seen an increased willingness to take on credit card debt. And so we're in a different place now. There's still savings, but they've been whittling away that savings a little bit. And so that was a huge tailwind for consumer spending. I suspect it's less of a tailwind than it was when this individual talked to you in the fall.
Do we see a big drastic shift in consumer demand after sort of pandemic government support is
Yes.
gone? And
Yeah,
that's
I mean, we were back at pre-pandemic levels of consumer spending like that fall. I mean, right in that summer, right after right during the pandemic, because the government was giving away free money, right? And so you saw huge increases every time they were giving away stimulus checks. So that really helped prop up the US. We had much more generous benefits than a lot of other countries, helped probably keep up the retailing side and really kept us afloat for much of that time period. And we were, seeing very, very elevated levels of savings rates for much of that time period. They've just started whittling away down to below pre-pandemic levels more recently.
Thank you. Well, I think that does it for questions for Chad here, and we're almost to 2 o'clock Central Time. So I'll just speak for everyone and say thank you, Chad, very much for your time. I see a lot of heads nodding, and your content is just second to none. I'm going to disseminate that across all of our membership here in the near future. So thank you so much for your time.